Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, and my guest is Omar Khan, Head of Wholesale Capital at the Alceon Group and Portfolio Manager for the Alceon Debt Income Fund. Welcome, Omar.
Thanks, James.
Omar, can we start by you giving us an overview of the Alceon Debt Income Fund, how it's structured and how it operates?
The fund is a real estate debt fund, which means we lend money to borrowers that might be looking to acquire a real estate asset, upgrade it, or redevelop it. And most of our business, and certainly for this portfolio, has a skew to residential real estate, which means it's typically borrowers looking to acquire a residential development asset for, that might be land development or construction of apartments or civil construction in terms of a residential subdivision. And from a origination and pipeline perspective, the fund co-invests with Alceon's other open-ended funds, syndicates, and of course, institutional mandates. And the way we as a business operate is that we have a central investment committee which approves all deals or loans for investment. But thereafter, for our open-ended funds, and certainly for the Alceon Debt Income Fund, we have an added level of governance which looks at those deals and sees and approves what's appropriate for that fund, both from a strategy and, of course, portfolio management and risk management perspective.
The fund's been operating for some time as a wholesale fund. What's behind the decision to open it up to retail investment with that minimum investment of $10,000?
So private debt or real estate debt has been very popular with family offices and more recently institutional investors for quite some time. But institutional quality of this asset class just has not been open to retail investors, and we wanted to change that. We wanted to bring that open and make it available across the advisor and wealth market.
Alceon is not a household name, so what are your key selling points and are they directed at advisors or end investors?
So Alceon, as a group, we're generally media shy, so we're not as well known. But I think what we certainly are is experienced. So across the team, there's probably about 19 and a half years of average experience in the real estate team. So it's a pretty experienced and in-depth team. In terms of capital, we manage probably over $2.5 billion in real estate now. And over the last 10 years, probably deployed close to $5 billion across 300 plus transactions. And again, goes to experience. And probably the most important element is alignment, where we co-invest with our investors and generally at least 5% in every deal and up to 20%.
Can you talk us through the key differences you believe you have compared to your peers and competitors, some of whom obviously may be much better known?
Yeah, I mean, if you think about it from a borrower's perspective, it's probably our speed of execution, our underwriting capabilities, and our experience. Probably 70% of our business is real estate. And so there's a deep level of expertise and experience in understanding the asset and the underlying risk.
What's been the fund's experience with defaults?
So to date, in the sort of 18 months to sort of 20 months that it's been going, we've had one default across that period, for which represented about 0.7% of the portfolio. And as it often happens with defaults, there was a process where that deal was put into default and a sale process was started, and that sale process is now concluded, and we expect by the end of the month all capital and interest repaid to the fund.
The expected return range that you quote is between 5 to 7% a year, but can I ask, what are your expectations for the next 12 months? Are they closer to 5 or closer to 7?
Well, look, we generally don't provide a return forecast, but what I would say is that our house view is that over the medium to longer term, conservatively positioned senior debt will probably generate somewhere between 5 to 7% per annum. And so, but certainly in the near term, And to date, we've been generating close to sort of mid-eights in terms of return. But there's certainly quite a bit of rate and return compression in the market.
Can we focus on liquidity for a moment? What are the main parameters around liquidity? It seems to me that redraws can vary from as little as a month or so to more than a year.
There's probably two elements to this answer. One is the asset class within itself. So, and this is a key competitive advantage for real estate debt, especially for residential real estate debt. Typical deals tend to be between 12 to 24 months. So that means short tenor. And the portfolio itself, the weighted average duration is around 12 months, which means that there's a regular flow of capital that's coming back to the fund and then being reinvested into deals, which naturally aids redemptions. And from a redemption perspective, we allow investors to apply for redemptions on a monthly basis, subject to an initial 12-month soft lockup. And those redemptions are naturally subject to available liquidity in any given month. And where that liquidity isn't available, the redemptions are prorated into future periods.
Just returning to that expectation on interest and yields generally and more specifically for this fund. So further downward pressure is what you're expecting. What's the house view on inflation and how it might affect that?
So probably inflation in terms from an economic perspective isn't probably as relevant to us. It's probably more from a demand and supply of capital. And certainly over the last 12 to 24 months, we've seen a significant flow of capital into real estate credit. And that goes to something you'd be well across, which is the demand for yield. Investors are looking for yield with assets that provide downside protection. And real estate credit or private debt is ideally suited for that. And so that flow of capital is what's compressing the returns.
Omar, should investors view this from the perspective of a real estate oriented investment and allocate it in that way in their portfolio, or is it more an alternative yield generating investment? Which bucket does it belong to, and ultimately does how it's categorised really matter to you as long as the investors want to use the fund?
Yeah, look, it probably doesn't matter to us so much in terms of us managing the fund, but certainly, we speak to a lot of portfolio allocators about this. And I certainly believe that real estate debt, secured first mortgage real estate debt, is probably more akin to fixed income than real estate, primarily because of the low correlation that real estate debt has to the underlying asset or the equity within that asset. So yeah, my answer would be fixed income credit portfolios.
What trends in this market for real estate debt and in the asset class in general, are you seeing currently and emerging? What putting your crystal ball to work, what factors are going to affect your market?
So I think it's probably the institutionalisation of this asset class. And the asset class has grown considerably over the last probably 5 years. And where the genesis of this asset class was probably through syndications and contributory mortgages, whereas now investors are able to access this asset class via well-diversified, open-ended funds of scale. And I think that for investors certainly changes how they access this capital and this asset class and how they invest.
Omar, it's been really great to see investments like this trickle down from the professional, wholesale, family office end of the market down to retail investors who really need the yield, given what's happened obviously with traditional sources of yield like term deposits. And term deposits and bank interest rates may never get back to what yield-oriented investors see as the good old days. So from your perspective, are real estate debt funds here to stay as a really viable source of strong yields for yield-oriented investors?
So I think global banking regulations have changed. And certainly in Australia, there is a clear pullback of the banks from parts of the real estate debt market. And it is no longer just about the cost of capital. It is probably difficult for banks to match the speed at which non-banks can move from a deal execution perspective and provision of capital, but then also from a structuring perspective. We can really work to structure deals to the needs of a borrower. And that's something that's really beneficial to those investors that you speak of, because we can create a product that the borrowers need and there is demand for, whilst also generating an attractive risk-adjusted return for those investors. And certainly from a scale and demand perspective, the Australian real estate credit market is probably $250 or $300 billion now. And of that, the non-bank market is probably 10 to 20 billion. And globally, the non-bank market is close to $1 trillion now. So I don't really see this as a short-term market. It's a market that's probably going to stay and become a permanent mainstay of credit portfolios.
And as you say, a very large runway for growth.
That's right.
This has been In Depth. My guest has been Omar Khan, Head of Wholesale Capital at Alceon Group and Portfolio Manager of the Alceon Debt Income Fund. Omar, thank you very much for your time.
Thank you, James.
A pleasure.